Hello everybody, welcome to the Leeb's marketforecast.com video for the 8th of January 2013. Today I want to touch a little bit on the CBOE volatility index, better known as the VIX index. It's also known as the fear index because it measures how nervous traders are. When the VIX gets very low, it means that the folks in the option pits are pretty complacent and vice versa. The trick though is that these same folks tend to be wrong, which makes the VIX index a contrarian indicator. In other words, a low VIX tends to precede a weaker stock market, while a high one tends to signal a buying opportunity. Low VIX readings make us a little nervous right now, especially when it's paired with a stock market that's trading near multi-year highs. And right now, the VIX is very low and has dropped very sharply since the calendar turned to 2013. The decline is being explained away as an indicator of relief following the passage of the deal to avoid the fiscal cliff, but we think there might be more to the story since options traders generally do not care which way the market moves as long as they're on the right side. Moreover, the deal avoiding the fiscal cliff really just kicks the can down the road, leaving the hard issues to be resolved in the debt ceiling debates, sure to take place within 6 weeks or so. On the contrary, though, there's a growing group of smart people on Wall Street who are beginning to believe that the markets are becoming somewhat immune to the permanent dysfunction that has gripped Washington. Historically, such a rapid decline in volatility expectations does not bode very well for the stock market. Going back to the early 1990s, drops in the VIX of 30% or more has resulted in a lower S&P 500 1 week down the road in 6 out of 9 instances. So stocks tend to drop, at least in the very short term, when the VIX is low. But while the stock market technically is overboard from a valuation perspective, stocks are not trading at levels where they typically cause concern. So we wouldn't just go blindly selling stocks just because the VIX is low. For example, if you look back over the past several years, there have happened several instances where the stocks have really rallied even despite the low VIX reading, meaning that had you sold your stocks, you would have missed out on sizable gains. Nonetheless, I mean, we have looked at the markets long enough to know two things. First, very low VIX and the speed of the recent decline in